Welcome back to Financial Pulse. In this video, I want to break down one of the most important themes I have been researching recently, the AI infrastructure trade. Most people still talk about AI throughout software models, chips, and the big hyperscalers, but the next layer is becoming more physical: data centers, compute capacity, energy access, land, financing, and execution. This video is based on my full Substack breakdown, but I will keep it more structured for video and focus on the main investment framework. As always, this is not a financial advice, it is simply my research process and my personal view of the sector. So the main point is that the AI is becoming an infrastructure story. The demand side is obvious: more training, more inference, more enterprise workloads, and more cloud capacity. But the supply side is much harder. You need power, land, grid access, cooling equipment, financing, and customers willing to sign long-term contracts. That is why I do not look at this sector as one simple data center bucket. I look at it as a chain of bottlenecks. If AI demand remains strong, the companies that control the bottlenecks could become much more valuable than the market currently assumes. This is where the sector gets interesting. The market often labels everything as AI data centers, but the companies are not doing the same thing. Nebius, Coreweave, and Oracle are closer to full-stack AI infrastructure or cloud platforms. Hut 8, Marathon, and Core Scientific are more focused on land, power, and data center capacity for large tenants. Then there are miners like IREN and Cypher that are moving from Bitcoin mining into HPC and AI cloud. Finally, there are smaller asymmetric stories like X Compute, where the opportunity can be large, but the uncertainty is also much higher. A key mistake would be to focus only on GPUs. GPUs are critical, but they are not enough. A company still needs power, data centers, cooling, fiber, customer contracts, and the balance sheet to finance the build-out. This is why some Bitcoin miners suddenly become relevant. They already had land, power, contracts, and operating experience with energy-intensive infrastructure. But that does not automatically make them winners. The important question is whether they can transform those assets into contracted, profitable AI or HPC capacity without taking on too much debt or dilution. The three reference points for the sector, from my perspective, are Oracle, Coreweave, and Nebius. Oracle has the headline number, roughly $553 billion, or to be more exact, after the latest earnings, $638 billion in remaining performance obligations, which is massive compared to the rest of the sector. But Oracle is not just backlog, it is also a profitable enterprise software base and a data moat. Coreweave has one of the strongest pure AI infrastructure stories with around $100 billion in backlog and has a powerful signal. Nebius has a smaller backlog but looks like one of the cleaner full-stack platforms. The key lesson is simple: backlog is important, but it is not enough on its own. Nebius is one of the clearest examples of full-stack AI infrastructure platform. It is not just renting GPUs, the company is combining compute, data center infrastructure, owned or controlled power, and land capacity, and a software layer for training and inference. The backlog is approaching $50 billion, validated by major customers like Microsoft and Meta. Compared with many peers, Nebius also appears to have a stronger liquidity profile, with much of the debt structured as a long-dated convertibles. But there is still a dilution risk, and the stock already had a very strong move. For me, it remains a reference point rather than an easy entry. Coreweave is probably the most important pure play comparison. The company has around $100 billion of revenue backlog, which is roughly double the Nebius one. That is a huge signal of demand. But the reason I am more cautious is the financing structure. In the latest numbers I reviewed, Coreweave has around $5.6 billion in current assets versus $70.8 billion in current liabilities. That does not mean the company fails, but it means execution has to be very strong. Nvidia is a major support layer as both shareholder and capacity backstop. Still, the core question is whether Coreweave can turn backlog into cash flow quickly enough. Oracle was one of the most impressive names in the full research. The headline number is almost unreal, around $638 billion in revenue backlog by latest report, which is roughly 5 times Coreweave current backlog. But Oracle is not only a backlog story. It is a profitable enterprise software company with deep database relationships, SaaS workflows, and Oracle Cloud infrastructure. That matters because enterprise customers are sticky. Once workflows and data sits inside a platform, leaving is difficult. My view is that Oracle may become a hybrid story, part SaaS, part cloud infrastructure, part enterprise AI inference. That is why I would watch it closely on any meaningful pullback. This is the part of the story that surprised a lot of people, Bitcoin miners suddenly become relevant because they already operate large energy-intensive infrastructure. They may have land, power agreements, substations, and data center shells. Those assets are valuable in the AI world where power and data center capacity are bottlenecks. But I want to be clear, not every miner becomes an AI infrastructure winner. Some only have optionality. The real winners need customers, contracts, financing, and the ability to execute the transition from mining to HPC or AI cloud without destroying shareholders' value throughout debt and dilution. Among the miners, IREN is the example that proved the pivot earlier than most. It already had large sites, renewable energy exposure, and operating infrastructure, and then secured major partners. I was skeptical before the big partner announcement, and in hindsight, that skepticism was wrong. Mara is different. It looks more like an AI optionality bet throughout the Starwood partnership and long-reach energy acquisition, while still holding a large Bitcoin treasury. Riot is also interesting because it already has a real AI customer throughout AMD, a meaningful Bitcoin stack, and up to 1.7 gigawatts of power capacity. These are not the same trades. The second layer is where the sector becomes very complex. TeraWulf has around $13 billion of backlog and a strong Fluidstack deal with Alphabet credit support, but potential dilution is a serious concern. Cypher has Amazon and Fluidstack exposure, but dilution still matters. Hut 8 has a large lease backlog and Bitcoin treasury, but the build-out needs major capital. Core Scientific has a transformational Coreweave contract, but customer concentration is high. BitDeer has impressive mining expansion and its own ASIC business, while White Fiber is a young public company with backlog but high operating costs. The point is not to dismiss these names, it is to price the risk correctly. X-Compute is the high-risk asymmetric idea in the bucket. The announced $260 million deal is meaningful because the company is still very small. The reported $43 million prepayment is especially important because if it appears clearly on the balance sheet, it would make the story much more tangible. There is also a reported multi-billion-dollar pipeline, but at this stage I treat that as potential rather than confirmed value. For me, this is not a high conviction core holding, it is a high risk position where the upside could be large if execution becomes real, but the downside risk is equally important to respect. This sector can be exciting but is also dangerous. The main risks are dilution, debt, customer concentration, execution demand, slowdown, and valuation. Many companies are using convertibles, warrants, or senior notes to fund growth. That can be fine if the assets produce strong cash flow, but it can also dilute shareholders heavily. Backlog is not the same as revenue, and revenue is not the same as free cash flow. Customer concentration can be a strength when the customer is high quality, but it also creates dependency. So my framework is not only to ask who has the biggest backlog, it is to ask who can execute without breaking the balance sheet. To wrap this up, my current view is that AI infrastructure may still be one of the most important sectors to study, but it is not simple. Some companies are full stack cloud platforms, some are power and colocation plays, some are Bitcoin miners trying to pivot, and some are smaller asymmetric bets. From a valuation perspective, the names I would watch most closely are Coreweave, Mara, and X-Compute, while Oracle remains the most strategic giant in the group. The key takeaway is that AI is not only a software and chip story anymore, it is also a data center, power, balance sheet, and execution story. Thanks for watching, and always do your own research. For the full breakdown, you can check my Substack, link will be in the description of the video, and if you want more of my unhinged content, you can check my X, and for more educational content, check my website. Links will also be in the description. Like, subscribe as a sign of support, and see you in the next video. Bye.